Welcome to Tony Byrne's View with news you can use. Tony has over 32 years of experience as a chartered financial planner and wealth manager. Tony's passion is to help you retire early and live the life of your dreams with no financial worries. Now to today's episode.
Should you defer taking your state pension? Can I delay my state pension? Although you can't start taking your state pension before state pension age, you can delay when you start receiving it. Doing so could result in you receiving a higher weekly state pension or even a lump sum payment. You can defer your pension for as long as you want, but you must defer the whole thing. Basic state pension plus any additional state pension you've built up. You can start deferring your pension even if you've already started drawing it in order to earn extra money from it. This guide explains how it works and whether or not you'll actually be any better off. Deferring your state pension, taking extra pension. If you want to try to boost your state pension by delaying when you receive it, you'll have to put off claiming it for at least 5 weeks. The amount you get in return varies depending on when you qualified for the state pension. If you reach state pension age before 6th of April 2016, for every 5 weeks you defer, you'll get a pension increase of 1%. This works out at 10.4% for every full year. The basic state pension is £137.60 a week in 2021-2022, or £7,155.20 a year. Deferring for a year will see you increase your annual state pension to £151.91 a week, or £7,899.34 a year. If you reach state pension age after 6th of April 2016, for people qualifying for the state pension after April 2016, the rate of increase falls from 10.4% to 5.8%, making the offer less attractive. This partly reflects the new state pension, which is higher than the basic state pension. The new state pension is £179.60 per week in 2020 to 21, or £9,339.20 a year. Deferring for a year will see you increase your annual state pension to £190.02 a week, or £9,880.87 a year. Deferring your state pension, taking a lump sum. You can delay taking your state pension and receive it as a lump sum, but you'll have to defer for at least a year in order to get the lump sum payment. Note that this option is not available to anyone who qualifies for the state pension on or after 6th of April 2016. It's worked out as if you had put the deferred pension into a savings account where it earned 2% above the Bank of England base rate, currently 0.1%, using a compound interest calculation. However, the Department of Work and Pensions adds interest weekly, not yearly, and this works out at 0.04% per week at present. Do I pay tax on deferred state pension? If you decide to take an extra pension, you'll simply pay income tax on the total amount of income you have from all of your pensions. If you decide to take the deferred pension as a lump sum, it is taxable at your current rate. You won't be pushed into a higher tax rate because you received a lump sum. For example, if you're a basic rate taxpayer at the time you come to withdraw the state pension lump sum, you'll be taxed as a basic rate taxpayer, even if the lump sum you get pushes you into a higher tax bracket. The Department for Work and Pensions will send you a declaration form when you come to claim your lump sum, where you'll have to say what rate of tax you currently pay. HMRC will check this at the end of the tax year, and if too much tax has been deducted, you'll get a refund. But if you haven't paid enough tax, you'll have to make up the difference. Should I defer my state pension? If you have retirement income from other places, such as a company pension, deferring your state pension might be a good deal. You could treat it like a really good savings account. Deferring may also appeal if you've retired to a country where your state pension isn't subject to the UK's annual increases, such as Australia. But you're giving up nearly £7,000 in income each year, so you need to be claiming the state pension for a number of years before you earn back what you've given up by deferring. If you reached state pension age before 6th of April 2016, deferring your state pension for a year only really pays off around 9 or 10 years after you decided to take the pension. If you reach state pension age after 6th of April 2016, the payback period is 17 years. Take your health into consideration. If you're fit and healthy, you could end up with much more money as you get older. How much could I get by deferring my state pension? We produced a table, courtesy of which you can find on the blog of the same title, dated 21st of April. Now, this table looks at the net loss or gain that will determine whether deferring would be profitable within different time frames. If you decided to delay taking the state pension, you'd still be in substantial deficit 5 years after you started receiving it under both systems, i.e. pre and post 6th of April 2016. After 10 years, you still wouldn't have made up what you'd lost under the new system, post April 2016. But under the old system, pre 6th of April 2016, your deferral would have started to pay off. For example, under the old state pension rules, delaying for 3 years would put you nearly £3,000 in profit after 10 years. But you'd still be facing a £10,000 deficit as a new state pensioner. These figures are illustrative and based on 2018-19 rates. They do not take into account that what you'd give up and the extra you'd collect would increase in line with state pension rises. Will deferring my state pension affect any benefits? Claiming extra state pension will affect any benefits you receive, such as pension credit, house benefit and council tax reduction. This is because the extra amount you get counts as income. However, if you decide to take a lump sum, these benefits won't be affected. If you're deferring your state pension, you won't build up any lump sum or extra pension for the days you're receiving any of the following benefits: income support pension credit, employment support allowance, job seekers allowance, carers allowance, incapacity benefit, severe disablement allowance, widow's pension, widow's mother allowance, and any type of state pension. Should I take extra income or a lump sum? This all depends on your circumstances, what you want to spend the money on, and of course when you reach state pension age. For those who reach state pension age before 6th of April 2016, the extra pension offers the best deal at the moment, as the interest rate on offer at 10.4% a year far outstrips anything you could earn on a savings account. However, if you're in receipt of any of the above benefits, you might want to think carefully about taking the extra income in case you're affected. For those who reached state pension age after 6th of April 2016, deferring your state pension is no longer an amazing deal. The long wait to recoup what you've given up, 17 years, means there's a risk you could not live to earn back the extra pension you deferred for. Taxation. Of course, none of the above examples take into account taxation. If you decide to carry on working post-state retirement age, and especially if you are a higher rate taxpayer, there may still be merit in deferring your state pension until you stop working, because you could lose up to 40% of your pension in taxation. If you continue to earn a very high salary of more than £150,000 post-state retirement age, you will pay 45% income tax on the excess. So by continuing to work for, say, 5 more years and deferring your state pension, you would have saved 40% income tax, assuming you were a higher rate taxpayer, which is equivalent to 2 years' worth of state pension, i.e. 40% times 5 years, meaning the break-even point would have been reduced from 17 to 15 years, which is only a marginal saving. Because deferring your state pension is no longer as attractive as it was pre-6th of April 2016, and because you do not know how long you're going to live, for most people it would be better to not defer taking your state pension. After all, a bird in the hand is worth two in the bush. You know it makes sense.
Thank you for listening to today's episode. If you enjoyed it, don't forget to share it with your friends and family. For more information, head to www.wealthandtax.co.uk.